Good afternoon. It is our final video recording for 2022. This is December's webinar. We're going to make it short and sweet today. Just Connor and myself. We've only got several slides to go through. We wanted to kind of catch you before it gets too crazy in your lives with all the holidays. And we also wanted to wish you happy holidays for you, for your family, and the best of the season and also health as well. Um, so we want to kind of go through December. Certainly, some of you are probably getting your November statements from LPL. Uh, Most likely on the positive side, they should be higher and should certainly be higher than the end of October's reports that came in middle of November of last month. So, and we hope obviously more of that, of course. But we're going to go through some of those options right now as we bring up the slides. Okay, so obviously a lot happened in 2022. We'll review in January kind of I even lost count at this point how many webinars that we've done and the pieces that we have sent out, in written form, in addition to weekly commentaries that you receive every, Tuesday or Wednesday of every week. So I'm sure at this point you're probably sick of hearing from us, and rightfully so. We put a lot of information out, but obviously we wanted to make sure that we did too much rather than too little. And certainly with a year like 2022, the way it's shaped up, certainly there's been a lot in the news to kind of go through. So we're going to go through some of these quick things today. Obviously we're still getting beat up with high inflation, although inflation is starting to go down, to come down a little bit, and we'll talk more about that in January. We're still, rising interest rates. Thank God interest rates have kind of come back or started to come back a little bit. We saw points where in October mortgage rates were over 7% for 30-year mortgages. Now they're in the sixes, which is obviously welcome news compared to, of course, being over seven, but certainly not as good, not even close to as good as where they were last year on this time, where they were in the threes or even sub three. So, but we'll talk more about the interest rate picture in January. A lot of geopolitical conflicts as well. Obviously with all kinds of issues going on, still at war with Russia and Ukraine are still at war with each other. Hopefully that would kind of you know end at some point in 2023. We can all be hopeful with that. And then obviously supply chain issues, they still exist. They've gotten better in some cases, and not so good in other cases. But we certainly still have a lot of things that have happened in 2022 that have put pressure on various markets, both stocks and bonds, rightfully so. So we want to definitely talk about some of those areas. You want to add anything to those, Connor?
Only thing I would say is obviously a lot of these topics here, they're correlated with one another. Rising interest rates, they're using interest rates to combat inflation, and inflation is caused by some of the supply chain issues. And hopefully, like Dan mentioned, a lot of that is getting worked out. So we should see inflation start to come back down, and we're already seeing some strong signs of that. But obviously it's been very persistent in 2022, as well as the geopolitical conflicts as well. So all reasons why we're seeing a lot of the volatility that we've been seeing.
Yeah, good points. Yep. Returns, obviously, I mean, it's what can you say? I mean, when you look at the returns of the Dow, the Nasdaq, and the S&P 500, obviously with the returns are in front of you, they're all in the negative for this year. The Dow is only 30 stocks, so we really don't use that one particularly. We feel a better measurement of how the market's actually doing is using the S&P 500 because it's 500 companies. instead of 30. So you figure, that's still down about 17%. And we just did this as of last week, Connor, right? And that last
Yeah,
Friday, maybe?
this is a Friday.
Okay, so Friday down 17. Nasdaq still is down close to 30. That's more your technology stocks and those issues. So we know certainly it has not been pretty, but that's where we are right now. We're going to both discuss this, but this is a very interesting slide and really one that we spend more time on because most of our clients have more money in bonds and stocks. And so it's funny when the market becomes volatile, especially the stock market becomes volatile, we are often surprised how many people call us about volatility when they really have very little money in the stock market. So, but however, this could be, the way it's shaping up right now, we've only got a few weeks left of the year. And I'm going to go out on a limb and safely say it will probably might go down as the worst bond year ever. And when we look at really from 1976 in this chart until 2022, I mean, you're talking about almost a 50-year period. And in this case, if you left out 2022, we've really only had 4 years that the bond market has lost money at all. And those 4 years, every one of those 4 years, the bond market lost less than 3%. If you look at the aggregate returns for bonds overall. This year, again, this has not been updated since September 23rd. But basically, we were looking at about a 13.8% drop from beginning of the year until now in bonds. So if this is going to go down as the worst year potentially in bonds, certainly the worst year in the last 46 years, at the very least, this would be the worst year by a lot. So with a few weeks left, I doubt very much that all of a sudden it's going to go from significantly negative to positive, since really that would happen if interest rates would really start to decrease. And although they've backed off a little bit, we're not hoping for a miracle like that. So this will effectively be one of the worst years, if not the worst year in bonds ever. And that's just a function of rates being increased enough, like Connor said, to keep inflation in check, slow the economy down, hopefully not put us in a recession. But generally speaking, that's what's happened. More of that to come. I mean, obviously, this week we're having another Fed Fund meeting. It'll be the last one of 2022, and then the first one of 23 will be in January. And so we don't expect there to be anything different there. They're still forecasting, an increase in interest rates again, which is also built into the bond market already. So nothing dramatic there unless it's really, drastically altered. But for the most part, we can only hope that bonds will be in a much better place in 2023 than certainly 22. Connor, how about you?
I'll just to add on there, we go back over 40 years here, and to be almost 4 times as bad as the worst year ever in 94. Yeah, just a function of them raising these rates very fast. Not something that we've really seen before, but it's also made bonds at this point very attractive because you never see bonds discounted as much as they have been this year. So, going forward, bonds look really good where they're at, and hopefully the Fed looks to start to slow down raising of the rates. And, at some point, I'm not going to say they're going to start cutting them right away, but that will be good for bonds once they start to slow down and then eventually start to cut. But yeah, bonds are at some point going to look really attractive.
Yeah, you mentioned speed of the amount of increases we had, pretty much every month there for a while it was increasing, but not only the speed, but the amount of
Mhm.
increases at those meetings, 3.75% increases in a row. I've never seen that in my career as a certified financial planner for 35 years. Never seen it. So we're talking about some things that, at least on the bond side of things, have not happened in my career. And so hopefully that kind of puts it somewhat in perspective. But hopefully the 23 could look pretty good. Like Connor said, these bonds are set up for a rebound at some point because that most of them are based on a function of interest rates going back down again and the reverse happening with what's happened in 22. Why don't you take this one, Connor?
All right. So as far as a bear market goes, so that's any time that an index drops more than 20%. So we're right now we're in a bear market, and the S&P went into a bear market. I believe the Dow did for a short period of time, as well as the Nasdaq is still down 29%. So this is just showing us what the S&P specifically did after the lows, and what the total drawdown was. Excuse me, sorry about that. And the total drawdown, and then the return after 1 year. And as you can see, it looks pretty good. It rebounds nicely, generally from those lows, dating all the way back to 1987. And then it'll show us here the 2 year after those lows, also very nice rebound. So right now we are in a bear market, and not sure if we've hit the low. I hope we have, but just kind of how quickly these things tend to rebound, which is why it's important to stay invested. You don't want to ride all the way down and then miss out on some of that rebound, because it can happen quite fast.
Yeah, good point.
And then here, so what we have is, so stocks after midterm elections, you know, uh, Dan always says there's usually a nice little honeymoon period after these midterms, whether that is a change of power or whatnot. So stocks tend to do pretty well during those periods. 1 year after those midterm elections, historically, it's up 14%, 1 year following them. So obviously, we just had our midterm cycle this past November. So just historically showing how the S&P has performed following those. Anything you want to add, Dan?
No, I think that's great. I mean, with a 14% average increase after the midterm elections, 2018 was the last one besides this one that just happened. Looking at a 12% increase there from the last midterm election. So the point of it is that, on the average, pretty good. And also when you look at, the consistency of not seeing pretty much anything since the 1940s, where the market basically did pretty well. And we did not have a single occurrence during that period where we were in the red, a couple of years later. So that's an encouraging sign. Beyond that. Okay, so basically, going forward, we will try and just keep it nice and simple. Obviously I know it's hard to trust in your plan. when you kind of think back at times before, if you were an investor in 2008, 2009, gosh, those 2 years seem to go on forever. And now when you look back, your mind obviously plays tricks on you, but you just don't remember it being that long. Same thing with the pandemic, when the market started to go haywire pretty quickly, those when you're going through it at the time, it seems like it's just going on forever. And then all of a sudden when it's over and you look back at it, you're surprised at, how long it really was. So the key thing is that, trusting in your plan means that, you're allowing us to believe that what we have done and the steps we've put into place, the processes we follow with management of your hard-earned life savings, um, that we're making sure that we're in good shape, that we're going through maybe normal things that most people are going through at the same time. And and that's unfortunate, but basically, trusting in your plan means that you're trusting in the process, that we have put it together, tested it, back tested, had others tested as well, and just put many odds in our favor as possible. So trust in your plan that it's still going to work next year, that we're, going to eventually, it's going to get back on track again. Um, and that's obviously the biggest thing in looking at your plan, and the fact that we have a plan for each client. That's why we spend so much time on it. If we do a good job with putting together the plan in the first place, then when we have hiccups like this, it's um, not too difficult to basically take it and then just move on from there. So trusting in that plan is on a lot of different levels. Try not to pay attention. I think you've been good about that. I mean, we really, honestly, we haven't taken a tremendous amount of phone calls this year. We've tried to obviously put a lot of information out there, been proactive about reaching out as best we can, um, to try and make sure that we're being considered of your time. But basically trying not to pay attention and looking at the information that is kind of thrown at your face every day is, really important too. And then always, as usual, reach out if you have any questions. I mean, even if you're coming in for reviews once a year, once every 6 months, if you want to accelerate that, hey, I'm only coming in once a year. I'm thinking that maybe every 6 months is better. Great. Just call us, let us know, and we'll change it over, and we'll start reaching out every 6 months for a review instead. At least while the market has been so volatile, and if it continues to be volatile like that, which we expect it will, then maybe more face-to-face contact would be good. So, we look for you to let us know, how that works for you. We certainly don't want to be pests and bother you and, continue to reach out for reviews when once a year is still fine. But we want you to know it's flexible. You can change it. You can come in as much as you want. We're not going to charge you anything extra for it or anything along those lines. It's your concerns that we want to try and be aware of, make sure of, and certainly, reaching out if you have any questions for either Connor or myself. Connor, is just become a certified financial planner. It's a big thing. He's been studying his, what off after the last, year or so, and it paid off for him. He's now a certified financial planner. So, you can always reach out to either one of us. And if it's not really anything investment wise, our front office staff, with Joyce as the manager of the office. She's been here for 13 years. Bonnie's been here for 26 years. Morgan's fairly new, been here a little over a year with us. So we have a lot of experience to draw on, probably between all six of us in the office, a good 60, 70 years of experience, in the financial world. So, you should always, use this as resources. I don't care how, maybe silly do you think the questions are. I mean, try us. We can always be very good resources for you on any subject. And if we don't know how to tackle something, we'll certainly let you know. But, no harm, no foul. I mean, if you call us, we're more than happy to kind of, to discuss any situation you want to go through, regardless of whether it's dealing with your portfolio, retirement, or anything else. Always reach out if you have any questions. Connor, how about you?
I'll just repeat that last thing. Reach out if you need anything. I know it's very easy to panic during these crazy times. So just know you have somebody here to talk to you, whether that's talking you off the ledge or whatnot. But always available to have a conversation, to talk through these things. And I think you would much rather have that than to make a panic decision. So always here to have that conversation as well.
Yeah, no, well said. So, yeah, I mean that's pretty much the meat and potatoes of this. We wanted to kind of keep it short and sweet. Um, and basically, if you just kind of put that last slide up, Connor, which is our disclaimer, we need to always kind of show that to you, so this way we're okay with compliance and everything as well. So, um, that'll pretty much do it for us. If you have any questions, reach out to us. We hope you enjoy the holiday season with you, your families as well. And we look forward to seeing you in 2023. Take care and get ready, because we'll be putting out a lot of information in January, and another longer webinar coming as well on top of a written piece, I'm sure. But we'll let you know how that looks for 23 as well. So thanks for tuning in. We really appreciate it. Enjoy the holidays.
Happy holidays, everyone.